The bottom edge here. When we're thinking about trading, I've introduced this subject a few weeks ago when we talked about the idea that everything we do is volatility based. The more volatility, the harder it is to trade unless you are trading a moving train. And if obviously you're trading a moving train, it's dead obvious. Trade with the moving train. So in other words, when you know what direction the moving train is going in, you're now starting to make sense of the moving train. We called this bottom edge in advance. You might remember it. We told you that the moving train seemed to be now stopping and turning. You might remember in live time on the right-hand edge of the classroom, I told you that in advance. How did I know that? Because this blue line is the train. Some people might think this blue line is a positive correlation. Well, it's quite obviously not a positive correlation because of what happened here. The idea is that we trade the greens and the reds when this is baseline bottom edge, right? This is what we call low VAR environments down here, which means that we can rely on the signals because the signals are generated from the market maker cycle. If we've got a low VAR environment, the chances are that the market maker cycle is going to be accurate. So when we're in a low VAR environment like this market maker cycle is going to be accurate and we're going to sell it. When we're in a low VAR environment like this cycle is going to be accurate and we're going to buy it. We've effectively just top ticked the NASDAQ and we've just bottom ticked the NASDAQ during that period, which is quite good. When we see a high VAR environment, and this is what we're really wanting to really get to grips with for other people that don't like taking those top edges and bottom edge fades. When we see a high VAR environment, you can see that the high VAR environment was created by this seller that came in here. Well, we should then mark off where all those sellers are. We had a seller there, we had a seller here. We should be marking off when we tap back into those sellers for an easy money sell trade. When we see the high VAR environment was here, we should recognize that there was a seller in here. We should be ready to tap back into that seller. And obviously there was a possible sell coming back in. And again, using that simple process of seeing, for example, a little spring trade there, you maybe got more selling. When it started to drop here, we're a little bit concerned now because this is now dropping. But then it started to rally again on this drop phase here, which gave us a lot of confidence that the selling is still absolutely legitimate at that price. So when the selling came in there, we had another great opportunity to keep pressing it at that stage. The problem is when we turn down here, all bets were off because now the VAR is dropping into the bottom edge. We're starting to rotate that cycle back into low volatility. Because we're rotating that cycle back into low volatility, it's now a high probability that any market maker cycle signal that we get is going to be a signal that the market makers will lean on. So when we get the market makers coming in at the bottom edge here, we can lean on that, and now we're in a very fast money momentum trade away, which means buying in here for argument's sake, or buying into this little pullback here, for example, buying into this little profit take with that pullback there, possibly even buying in here, and you're aiming for top edge liquidity. So when we started to tap liquidity and I started to see the volatility cycle not extending, I'm going to start booking my monies to the point where I'm going to be now exiting out my positions, and I am delighted with that phase. And now what I'm doing is I'm waiting for the next read. You can see on the retest here, the volatility is now dropping. So we know that this retest is probably the end, for the time being at least, of the up move. If we start to see this leg starting to turn the volatility back round to the bid side, then we know that there's now a very easy top line sell, just like it did up here. We're going to start recognizing the possibility of a top line retest. But obviously, this is not a low volatility environment. It's a dropping volatility environment, but it's a very high volatility environment. This is what a low volatility environment looks like here, right? So you get to know these things. So when we see these types of things here, we want to be dealing the market maker cycle heavily. And that's resulted in the most perfect swing trade you've ever seen, really. crazy opportunities to catch some of those swings. So this is one aspect of trading, isn't it? When we think about our trading, this is one aspect that we can start using indicators for, but we still have that ability to interact with the story. It's not just a green paddle that appears. Sure, there was a green paddle here, I never bought it. And there was a red paddle here and I never sold it. Well, I never sold it to get net short. I did take some profits, and I did take some profits here as well. But there's a difference, isn't there? A very low paddle value is a buy trade, and a very low paddle value here is a sell trade opportunity. We should be more active in those environments. The market maker trades according to implied volatilities. If we don't understand that, we're not going to get this story right. If the market maker trades implied volatilities, why do they do that? Because the most important thing, which was identified by that chap in New York again, and we come back to him again, when he said, you don't stack your bids. Well, sometimes you do stack your bids, Jack, right? So, for example, when we see this collapsing to the bottom edge, the market maker will closely stack their bids in here. When you see that top edge there, the market maker will closely stack their bids. And we can start looking for evidence of that stacking of the bids. But if they were trying to stack offers here, it's quite clear they didn't stack their offers during that rally. And we can see that they didn't stack their offers because the price exploded north, which is absolutely fantastic, isn't it, when you think about it? Because if we know the market maker isn't stacking their offers, well, they might well be stacking the bid, and we've got this volatile skew. So when we understand this, I think it's true of any trader, Jack. It doesn't matter whether it's a market maker or any trader. At the end of the day, if I'm trying to buy a high volatility market, I'm going to have my orders well spaced out, whether I'm a market maker or not, right? If I'm trying to sell, I'm going to have my orders spaced out, whether I'm a market maker or a short seller, because I'm going to get trampled on either example. If I'm a market maker or a trader, as a prop trader, I'm still going to get myself trampled to death by volatility if I'm wrong. So when volatility is rising, you can see here, for example, volatility is rising. If I was buying this as a prop desk or anybody else, if I started to see volatility rising and I started to stack heavily in this area, that would cost me a lot of money. So when I see volatility rising, what am I going to do with my buy orders, for example, in this area? I would pull my buy orders to give myself a bit of space, so that the volatility doesn't trample me to death. And that's obviously if I was a buyer in that location, it gives us a few clues to make sure we don't miss out the opportunity at that point. Now, this takes us to some of the indicators that we're working on as possible triggering indicators. And, it takes us to kind of yesterday's marketplace. Because obviously when we look at yesterday's market, there's a couple of things that happened in yesterday's market that were kind of borderline insane. Obviously, we're working on this as a process, guys. We're working on this as a process. They're not by any means 100% done deal at this point, but we're getting there. Slowly but surely, we're getting there. But when we look at it from a point of view here, this is yesterday's S&P from the cash open, right? So from the cash open, this is yesterday's S&P. We're not hiding any part of this chart here. Let's get rid of the drawings for a second here so we can see that it's a clear chart, and all we've got on the screen now is the key levels, right? All we've got on the chart is the key levels. Well, one of the things that we're working on is to try and give us a story. This isn't buy and sell triggers. It might be buy and sell triggers in the right circumstance. One of the things we've been working on is really the big program buys and sells, and this is what the big program buys and sells had for us yesterday. Is that not quite interesting? Well, it's kind of interesting because big commercial program buys and sells usually come in from big commercial liquidity levels, because liquidity brings in the reason for big program buys and sells. Well, two of these triggers were into big commercial buy levels, and only two of these triggers. The two triggers that were into commercial buy levels or sell levels were this one and, of course, this one. So when you look at those program trades, you're looking at them and saying, wow, well, I think that's pretty good, personally. Obviously, not a lot of reaction to those two, but early days, right? Early days. We don't know how it's going to play out. It's only one couple of trades, right? It's only one set of trades from a one day to try and understand this process, and it's not finished by any means. But if we can get close to this, we're in pretty good shape, right? Why? Well, because that program sell top ticked the NASDAQ yesterday, and that program buy bottom ticked the NASDAQ. So out of four trades, we actually bottom and top ticked the NASDAQ, which I think is borderline unbelievable out of four trades. Three of the four trades made some really good money, and one of the trades actually would have been a stop out for a loss, right? This one here would have been a stop out for a loss. So I think we're on a good path here. I think we're starting to see some interesting elements. But what else have we got that might be of interest here? Well, of course, one of the things that we've been always working on in the background is to try and figure out where the market maker is most likely to be bidding and offering into these stories. So I've got the market maker equity bids and offers here. So this is what it looks like. That's also what I believe is a very good indicator because it's forecasting a bid and it's forecasting an offer. There are two examples here where the bids and the offers didn't turn out to be true. If the market maker bids a level, we should cycle into the next high. If the market maker offers a level, we should cycle into the next low. And if we don't, that's a problem. So there's a couple of things that we want to be paying attention to. There is obviously a couple of trades in here that didn't cycle the price. Well, that in its own right is a signal. See how they didn't cycle the price against that offer? And the price went higher? Well, you'd now look at that and say, well, I have a good idea that this is probably a buy, and it's probably targeting the day session high liquidities. So we're already getting a feeling about that as a bit of business. You can see the second time they didn't cycle the price when you were expecting them to was here. So when you recognize that that cycle didn't happen either, you're now looking at the same as what we got here, and you're now looking at that and saying, well, I think they're going to try and cycle this back to the low price. And obviously you're now looking at the low price and saying, well, I think that's what's going to happen here. And they cycle the price back towards the other side liquidity. Just about every other trade did cycle. Just about every other trade did cycle. So when we recognize that just about every other trade did cycle, well, that's pretty good. There's something else that started to show up, which was interesting, because it's only when you get into this as a process, you start recognizing interesting elements to this part of the storyline, right? When we look at this as a process, one of the things we talked about the other day was the smart entries. So when we think about smart entries, what does smart money do? Well, what we contemplate smart money to do most of the time is manipulate. Would you agree with that? Smart money manipulate everybody else. So interestingly enough, when we look at smart money, and we start looking at what they do predominantly, because this is obviously just a simple basic algorithm. When we look at smart money, a vast majority of smart money entries are for liquidity to reverse the marketplace. Take a look. Do you see what the smart money do in most locations? Smart money, buyers to try and get higher liquidity, buyers to try and get higher liquidity, sellers to try and get lower liquidity, buyers to try and get higher liquidity. Do you see that? The vast majority of smart money trades, for example, this buy trade here turns out to be a sell at that price. This sell trade turns out to be a buy in that trade area. Now, I'm only going to take it down to the liquidity to find where the liquidity was there. And then the liquidity was there. And then obviously we never had liquidity in this one, but it turned around almost immediately here. And so on and so on. So in other words, this is also very useful. Because sometimes there is a breakout trade. Like here, you've got smart money selling here, smart money selling here. Now, this is when it starts getting really quite interesting, and we showed this morning in the London session. When we look at the smart money buying and selling, one of the things you start recognizing is that the smart money buying is trading into a market maker offer And a smart money seller is trading into a market maker buyer. Let's take a look. You see that? So what develops is a sandwich. You've got a market maker offer from that smart buyer right there. Do you see it? So they're creating a condition called a spoof. You see that spoof there? And they created a condition here called a spoof. And they created that condition again into the bottom edge here. See how we can draw a sandwich between these two prices? And we fill it with spoof orders there. And we got another spoof just here. You see it? So there's a smart sell into a market maker buy there. So we got another spoof there. And you can start recognizing some of those spoofs, can't you? You can start recognizing there was a spoof in this area, smart buyer into a market offer, spoof. So when we start recognizing that this can start helping us identify some spoof tradable areas, and then we recognize why some of the spoofs actually extended even further, we recognize that the spoofs actually are part of that program trading concept. So you can see the smart buy took us into liquidity for that program sell. You can see the smart sell took us into that liquidity for a program buy there. We extended the smart sell there, and we extended the smart buy there to get program tradable levels. And all of a sudden, we start getting something really quite exciting as well. We start seeing other pieces to this jigsaw puzzle. We start adding that into our thoughts. We start considering that there is a story in here that might make sense to a lot of people. Yes, it's a lot of green and red things on your screens. Yes, it's part of the story. But the idea is that if we can learn the story, then we can always we don't have to always have them on our screens. But we can have them on our screens when it's relevant to have them sitting on our screens. So when we see that in line with, for example, max divergence, for example, and we look at the specs and various other things, you know, when we look at some of the spec elements, we can start recognizing some of the market trades here. So we saw the MXD2 from that smart sell. And all of a sudden, you're getting a real strong sense that that smart sell was trying to achieve that manipulation. It's helping us to identify that manipulation price. This smart buy into an MD3 was trying to achieve top line liquidity for that sell to come in at that price. So all of a sudden, we start seeing some crazy opportunities to trade spoofing. Something that's never been achieved in the retail space before when you see trades like that, when you see trades like that, and when you see trades like that. I mean, these are all trades that you would now be able to recognize as potentially real. This spoof at the bottom edge here to achieve this bid here, you could have been buying into that. So when we get the bottom edge here, smart sell into an MDX2, you can obviously look to buy into that. You see the smart sell into this bottom edge program buy, you could be looking to buy into that. And all of a sudden, our chart starts to become very, very, very interesting. We start seeing some crazy signals that might just highlight some crazy good opportunities. Is it enough to verify that we're in the right place at this point? Possibly not. But is it starting to look like it could be a storyline that you can all buy into? What we might do is we might change the smart buys and the smart sells from reds to blacks so that we can understand that it's not an actual bullish or bearish signal, that it's a manipulation signal so that it doesn't stand out as a buy trade and people don't get mistaken. But it is a buy trade, a smart buy. But the smart money is buying it to sell it at a higher price a lot of the times. So when we get these smart sells, you see we don't sell into anything, do we? We don't sell into a market maker. We don't sell into an MXD2 or a 3 or a 1. We don't sell into a program buyer. We sell into a big void of liquidity. So that smart sell was correct to continue that process. And this is before we ever start looking at this idea. And this is before we ever start looking at this from a volatility point of view, where we start recognizing the big shift in volatilities. Yeah. So when we look at that idea of the void, well, maybe that's exactly what happened here. Maybe that's what was picked up here, was that void sell. So this is going to be something we'll be able to watch today to see if it has anything to offer us in terms of trading opportunities today. You know, we could obviously start looking at these as signals, as possible processes, and if we can highlight the idea of it, you can see in here, for example, that this was smart buying into selling, right? So into selling. So we would imagine that this is one big spoof phase. So you'd imagine into the last couple of bits of business here, we'd imagine that this is probably a sell, right? And it turned out you were right. It probably was a sell at that stage. You can see that we're into the closing phases again. We got another few spoofs in here into top edge liquidity in this case here. And you got another opportunity to sell there and again made some money. And obviously we're now coming into the close of the day and you're probably not going to get terribly excited about anything. You're just going to leave it alone at this stage. So when you look at the possible trades that you've been able to pick up from these, I think they're pretty good. Maybe you disagree, but I think they're pretty good little ideas. They still fit inside of the rest of our stories in terms of value. They still fit inside of some of the other elements. But the point is, it sticks to our basic assumption about the markets, that it's not about indicator-driven markets. It's about trying to figure out that the indicator can help us highlight the things that we're hoping eventually to see for ourselves. So if the markets can highlight, if the indicators can highlight these areas so that we can learn better, rather than me rabbiting on in the background, you will learn from these indicators that that's what we're looking to try and expect. And if that's how it plays out, we stay true to what we set out to do, which was try and teach people about institutional trading. Try and teach people about how the institutions work these types of ideas, that there isn't a single cause that makes everything happen all the time. It changes with time, but these are market truths. These are things that should be on top of any value storyline. They should tie in with our volatility storyline. They should all be part and parcel of the things that we do in trading. And because of that, they make more sense. If they make more sense, we can deal them. They would then be able to fit inside things that are happening on Delta, for example. So when we see a Delta buyer coming in here, we see that the book is offered and we see that they cycle the price lower, we can sell that and make some easy money. It turns out $200 in 2 minutes. Nice trade. So we'll see what happens today in the cash open, because obviously cash open today is going to be crazy, right? We're going to get a lot of weird shit happening because of the Fed this afternoon. So we're going to have to just be careful not to be too inclined to jump on anything. We're just going to have to be a little bit more standoffish until we see what the Fed has for us, and then we'll pick it up from there. So you can see just how good this process is. It's one of those processes that when you start kind of getting into it, when you start considering some of the elements, and you look at these MXD2s and the MXD3s and the program buys and sells, they triggers on their own are gold mine stuff, right? I mean, if you just traded those triggers on their own, even take the programs off it, they still provide us with some pretty big gold mine opportunities to make some crazy trades, right? The MXD 1s and 3s here for that buy trade there. The buy here for that sell trade was crazy. That buy trade there was good. Sell into a buy. They're all pretty good trades. Every single one of those trades made money. That was a 100% win rate for an indicator, guys. 100% win rate for an indicator, which I think is pretty good. Now, obviously, when we add in things like Max VAR, for example, some of these indicators might say, well, you want to avoid being too hasty in this trade, right? So when we look at, for example, Max VAR, you can see that Max VAR is really low for this buy trade here. How good is that? How amazing is Max VAR for that buy trade? Crazy amazing, right? Because a big decline like that puts us right into the right steering wheel at that point. When you see a big drop off in Max VAR here for that top edge sell, now we don't get a cycle sell at that stage, which was really disappointing. But we did get a cycle sell up here for that trade there, for that big drop phase, didn't we? We got a cycle sell in there, which gave us that big drop phase there. So the VAR gives us some crazy good trades as well as winding up some of the concerns, because if we'd got any signal during this phase, we wouldn't be taking it anyway, would we? Because obviously that type of phase there is the kind of phase that's going to kill you as a trader. That phase there is the phase that's going to kill you. So if we got a signal in here, we wouldn't be taking it, would we? So when we see the idea of this, we now recognize the incredible power of VAR, the incredible power of VAR, because it's also the ability to recognize that VAR has peaks that generally are honest and true. So when we recognize that VAR has honest tops and bottoms, so you can see here there's a very, very high ledge, which is the highest ledge we've got. You can see that this retest here is also at the very high ledge, and you can see that this bottom ticks price here, and it does bottom tick price here. So when we see that VAR also has these ledges, we kind of recognize how easy it is to start spotting some of these clues. You can see how low this is here. Well, we know that without even a signal here, we know this is going to be a buy trade. So we start looking at other elements to that as a possible buy trade there, don't we? We start looking at the fact it's a measured move. We start looking at the fact of whether any sellers are getting trapped on that phase. So when we kind of see this and we start recognizing how powerful these elements can be, either on their own or combined with other pieces of the jigsaw puzzle, we can start recognizing the incredible power of this story. Take a look at what's happened since we talked about it. So we talked about Max VAR being a big sell trade here, and we talked about Max VAR being a big buy trade here. Well, look at what happened at the top edge. Look at the big drop here. So because of that big drop, if we'd got any cyclical calls for a sell up here, we could take them, couldn't we? Any cyclical call for a sell up there could have been a nice opportunity to sell into that. Would you agree? So we started to look for those elements. We can start considering whether we got any signals in those areas. Did we get any signals in those areas, yes or no? So because we then get a signal in that area, we could say, well, I'm going to start working that 730. I'm happy and I'm comfortable about how low this has gone here. I'm happy and comfortable now to get into that as a bit of business, and I'm going to be aiming for cycle low down here, because it is in a low cycle state, so we're not expecting this market to extend to the downside, because obviously that never turned up, did it? So because this never turned up, we're expecting it to bounce off of that. So it gives us a realistic target for the sell, doesn't it? So it keeps our ideas in check. So if we've got a realistic target for a sell, I don't overstay my welcome on that short, right? It's like this trade here. When we get the buy trade there, this is now extending, so I'm not going to have a realistic target of a sell trade here, because it's not going to be a trade. I'm not going to have a realistic target of a sell trade here. I may have a realistic target of a sell trade here, because that's now swing high. That's now session highs, right? It's now session highs. So because it's now session highs, we've got a realistic idea that that is what the cycle is now identifying, because that is the highest time cycle we've got. It's session high to session low is the highest time cycle we can have, isn't it? So when we trade into this area, we then have a realistic target and say, right, we can bag this. And Kim had highlighted this as one of the most important things as far as she's concerned. One of the things Kim said to me was the thing she sees a lot is that people have a problem holding an open position. And one of the big challenges is, when do you say enough's enough? Well, you say enough's enough because the cycle changes. So when I'm holding an open position from a long position here, and this is exploding like this, I'm going to keep cycling this price higher until it stops moving, until it hits that big cycle that was telling us it's going to hit the big cycle. And the big cycle is either going to be a green level, or if it's even bigger cycle, it's going to hit a black level. So that's what we start recognizing as the reality. You could have bought this trade here at 670s, and you could have held it all the way to 730s. That's a 60-point move or $1,200 profit in a period of just 25 minutes, Johnny. 25 minutes. There's very little in life that you can't do in 25 minutes, are we right? Well, making $1,000 in 25 minutes is exactly possible when you see a trade like that. When you see that size of volatility smash, we can make $1,000 in 25 minutes. Now, obviously, that's all about what happens next. I mean, we don't know how far it's going to go. We don't know how fast it's going to go. But when it goes that far and that fast and it's highlighted, we're in a very good shape to recognize it. So we already called the exit on that short sale on the NASDAQ, didn't we? So we called the exit. How did that exit do? Very good, thank you very much. Why did we know the exit was going to be in there? Because this is telling us the cycle is very low. And if we know that the cycle is very low here, I want to simply look at this from a top to bottom type cycle. So I'm thinking, okay, well, top to bottom cycle now looks a little bit like that now, doesn't it? So that's what the top to bottom cycle looks like. So I start considering the possibility that a signal through the top edge at 730s might be a sell trade. Does that make sense to everybody? So this hopefully explains the concept of market maker cycling. What we're trying to do as an exercise ultimately is to show you that if you know what the market maker is likely to do, you are going to have a very, very good idea about what the price is also going to do. If you don't know what the market maker does, if you don't understand what their model is in terms of volatilities and in terms of cycling, you're never really going to get a grasp of the vast majority of price action that you see. The vast majority of price action is based on their adding and subtracting of liquidity. Not all, but the vast majority. Sometimes there's a fundamental driver, and we have to acknowledge, like the Fed is a fundamental driver. Well, I'm not going to try and cycle the market maker on a 1 minute chart, guys, right? That's not going to happen. It's going to be false. So when we see that cycle, we recognize that that is a higher time frame cycle. Hopefully it makes sense. Eventually it will, because this is obviously what we're going to spend a vast majority of time in the new classroom talking about, is this concept of cycling the market properly.